Imagine that you are dealing with your family wealth and you decide that you want to be really conservative. And so you set up your portfolio to do perfect capital preservation. You don't want any growth. And so you set up your portfolio to have zero risk of loss. You set it up so that each time the coin of the economy is tossed, it's set up so that if the coin lands heads, your capital will grow by 50%. And if it lands tails, it will shrink by 50%. Modern portfolio theory economics will tell you the average after each coin toss stays at 100%. If you just keep going, you will trend to average, and the typical outcome of your portfolio at the end of a long enough period of time will be the perfect capital preservation you target. Now let's look at what actually happens, starting first of all with this branch that begins at the first toss with 50% growth. Then we'll look at the bottom branch in the slide after, and then we'll put all two branches together, which is a bit small to see in text on the screen, which is why I've split them. So the first branch is not looking too badly. By the time you get to the fifth coin toss, there are quite a few that are marked with an arrow where the growth is above 100%. And it looks as if those pretty well balance out the ones where you've gone below 100% by the fifth coin toss. However, if we look at the branch that starts downward, you see something that is a little bit different. Only one of them is above 100%. All of the others are well below, down to one outcome is at 3%. What you're seeing here is the difference between average and typical. For every single coin toss, the average stays at exactly 100%. But what is important for your wealth is not the average of all possibilities. What is important for your wealth is the range of typical outcomes you are likely to get at the end of 5 coin tosses. And what we see here is that 26 of the 32 possible outcomes at the end, 81% of them are below average. This is the important message to take away. In the non-ergodic universe we live in, the institutions of incorporation and investing are unwittingly setting us up for outcome where the typical performance that we can expect is strictly below average.